if you're a JPEG collection and your price just collapsed 99%, vaya con Dios, amigo. Good luck. This is why I think, again, nuance. I am highly skeptical of artists moving into this direction without being very thoughtful. And music royalties on chain, like all of that, I want to believe it. I just think it's challenging.
This episode is brought to you by Toku. If you are planning to launch a token, already have a live token, are granting employees or contractors vesting token awards, or are just trying to figure out how to take care of taxable token events for your team, from easy to use token grant award templates through tracking vesting to managing tax withholdings, make it simple today with Toku.
Welcome back, everyone. We ended the last pod. You have Tommy and Ryan yet again, two of my favorite people in the space. And we ended the last series pod talking about things that are overlooked in a bear market. And we were talking about investing, right? We could continue on that track here. There's just so many things that, we've gone through. We've invested in a number of categories. We've gone through multiple cycles. The industry looks very different, but yet the same in many ways. So anyways, I guess in that vein, we don't want to go too deep on current events. Obviously, the front and center is FTX. There's a lot of things that have come to light that I think a lot of the industry got right at the time things were going down. There's a lot of speculation. We can go into that. We can talk about a lot of the different counterparties. Of course, with all this, there's FUD that comes up, right? There's FUD around Tether, and FTX was very involved in Tether and minting USDT. And so, of course, there's some takes that are good. There's other takes that are just, spreading FUD. So I'll kick it off to you, Ryan. Maybe along this kind of thread of things that are overlooked, one of the things that we talk about a lot is FUD. It could be paralyzing, but it is also really important to call out and be, surface the truth and when you see it. So anyways, we were talking about Binance. We were talking about Tether. There's the FTX stuff. I know you wanted to talk about this, so I'll pass it on to you.
Yeah, one of the things that is definitely overlooked in the space is, and we've seen this and we're all paying the bill, is the collateral damage of bad actors. And, the solution over time is to lift up some of the citizen journalism that calls out things that don't quite add up, Jesse from Kraken this past week, went on record stating that it was very obvious to them that just the 2 + 2 = 4 math did not add up with respect to FTX. And they knew, because they knew their own business, that there was something amiss. Brian Armstrong has said the same, that he kind of knew FTX's volumes. And because of that, their expenses, there was something very clearly amiss. And I think hopefully as we move forward, we pay attention and people are willing to do the call outs. It's kind of tough to put yourself out there and call out a powerful organization that could potentially be operating correctly, could potentially not be operating correctly. This pod, we've discussed what are the implications of whether Binance is doing some things incorrectly with respect to their chain or with respect to their exchange. A lot of people have questions about Tether, and this is an interesting thing because yes, you need to call out the organizations that are potentially doing incorrect things, but then there is a nuance that I think needs to prevail. So, for example, I have a lot of questions about Binance, and I'm very concerned. I'm not touching anything Binance at this moment. Tether, on the other hand, I've sat with Paulo. I know this organization to just be one of the best companies in crypto. It's certainly one of the most profitable companies in crypto. And my own analysis of it is that most of the FUD is being driven from, competitors that wish they had such an amazing business, right? Tether throws off $3 to $5 billion of free cash flow every single year. It is an extraordinary business, and a lot of people, wish they had that, and so that causes the are they collateralized? Are they not? The reality is that they're collateralized with off-chain assets fully. And then they're even more collateralized, probably close to 180, 200% collateralized when you add in their Bitcoin position and their crypto position. So I actually look at it as a very, very de-risked organization. That's different than FTX. That's different than Binance. And we have to have that nuance and understanding that like not all big off-chain organizations in the space are bad. But when we do see something that we are concerned about, that we investigate it further. And, I did that with Tether, and I came out the other side being like, actually, you know what? This is a really great business and they've done a great job. So yeah, I don't know. What do you guys think?
Yeah. I mean, one of the crazy things is like, it kind of comes down to memory. Like we have Mt. Gox, and yet fast forward 9-10 years and we have FTX, and nobody really cares about proof of reserves, right? Like it's like we learn the lesson and then we forget about it, and then we have to learn the lesson all over again. So I don't know what like changes this time around that, we're not going to have to learn this lesson again in 5 years.
That's a really good question. I mean, I think I do want to make a distinction back to your point, Ryan, on Nuance. Mt. Gox was an issue where my understanding was that they had a bug in the system where they didn't catch, like the withdrawal math just wasn't adding up. The people running Mt. Gox, you could argue, were incompetent, but I don't think they were doing things in a fraudulent manner. Whereas FTX was just everything that has come out to light is fraudulent. They were taking customer assets and then using them for other purposes, political donations, investments in things like Anthropic that may or may not pan out and make us all whole. But still, that's fraud. And so it's a very big, important distinction. The question is, and I think it's a right one and a good one, Tommy, which is there's probably another FTX out there. Maybe not to that level of magnitude, but fraud is fraud and it still hurts people. You could argue that some of the hacks on chain of protocols, were those inside jobs or were they not? Like there's reentrancy attacks in the code at this point. If you're a project and you have a reentrancy vulnerability in your code base, that's just like negligent, borderline fraudulent, to the point that I'm going to be suspicious that it's an inside job, because it is, it's at this point, there are no excuses if you have this type of stuff. And so, Ryan, I want to go back to something you said, which is really interesting. You mentioned now, of course, after the dominoes fall, a lot of people come out and say, we told you so. We knew something was wrong. But how vocal were these people? Like how vocal was Jesse or Brian publicly, or maybe they went to regulators and they didn't want to listen because FTX was the charm and was the best and had all the, checked all the boxes for. I'm just kind of curious how all that unfolded. You're
right. I mean, I think privately, a lot of us were having this conversation, but none of us really were saying it publicly, because at the time, Sam had an incredible amount of political power, and we're all just trying to make our way in the world, and nobody needs to procure unnecessary fights. Right. And so for another CEO of an exchange to call out a different CEO, imagine Brian Armstrong calling out Jesse or vice versa, there's sort of a decorum of respect that I think most executives confer to other executives in the space, that unless you have real evidence, you could be slapped with a slander or libel suit, and that's going to be a distraction. Nobody wants that. But I mean, I had conversations with you guys talking about how things didn't quite add up with FTX at that time. But you're correct in that we were not explicit enough, and there weren't enough people really calling it out. I give them a pass because I understand they're just trying to run their own business, but we clearly need to get beyond that, and we need to self-regulate as an industry. Otherwise, the regulation that we're going to be subject to is going to be, I think, far worse in the end. And so hopefully people have more courage next time around and we catch it earlier and we call it out earlier.
Yeah. Tommy, I want to go back to you on things that are overlooked beyond the kind of FUD. But what is interesting, Ryan, to your point is during the testimony of Caroline, she mentioned one of the priorities of Sam was to put regulators onto Binance. And I think that might have been the catalyst for CZ to say, not only were they looking at the flow, right, that Alameda was transferring into Binance to ARB some tokens, but they were huge holders of FTT. And at some point, they probably caught wind of this and they said, enough is enough, right? And you just, and that was kind of really the trigger. I think Sam did a huge damage in the industry. I mean, he was very vocal of DeFi, critical of DeFi, naturally, right? He was against transparency. And I think we're at a very interesting crux here. I hope that even with this whole like Israel-Palestine situation, where people are saying, oh, look at Hamas, they've received crypto, and, Senator Warren is being very, very critical of crypto. Whereas the reality is Hamas even told their donors, like, guys, stop sending Bitcoin. It's transparent, and you're going to put a target on your back, and then their donations really cliffed off crypto. But it is really important to be nuanced and just to understand, like, we should be asking all of these organizations, like, hey, proof of reserves, like, just procure them. There's really there's no excuse at this point. Tommy and you and I are both investors in this company called Test Machine. I just saw the demo. Like, there should be, and it's like a company is like building a detection solution to, like, in real time, like, basically it's a model that has been trained to detect certain vulnerabilities in the code. And I think something like that is a fantastic thing, because clearly audits are not enough. Audits and bounties also not enough. So what else can we do? I think we as investors can say, hey, if I'm going to invest in your company, then you need to have these things. You need to have, obviously, audits and bounties, but also use solutions out there to prevent, attacks, to close in on the surface area or the potential surface area, and to, like, mitigate, like, exploits and bugs. I think that's really when the investors really, I think the best investors can really say, hey, we're going to do this deal, but you need to do X and Y constantly, because things can't break.
Do you think that one of the overlooked things in the space today, because of what's happened with vulnerabilities in DeFi, as well as the hacks and lack of proof of reserves on chain, is this kind of SaaS era where, like, Fireblocks has come out of nowhere and is now, I think, one of the top 10 highest valued companies in the space. You guys just mentioned that this new service that comes up. We use Hibernative. In fact, for our yielding, we use close to a dozen different services that have different sort of like alerts and checkpoints against code and things like that to automate our due diligence on pools and on projects. Do you think, like, are we seeing the emergence of the SaaS era in crypto?
Yeah, I mean, just a couple things. I mean, to go back to Santiago's point, I do think it is on us to, like, help allocate and secure crypto for the future, right? Like, two checks that we're really excited about is, one is what Santiago mentioned. Test Machine is an AI model built by ex-DARPA guys, really smart guys. And instead of waiting 6 months for an audit, a developer plugs in their GitHub code, automatically gets an audit, automatically gets fixes, right? That's helping to fix the on-chain world. The other thing we did recently was Heights Labs, right? Which is an automatic evidence graph following a hacker and the flow funds. You could hand this to a government official and get a subpoena or a warrant, ASAP, instead of having to go through this manual process with the larger competitors we all know. So I don't know. I think it is on us to help, do that. And look, there are opportunities to make money there, right? And then on the flip side, we need to protect the centralized world more, right? Like, I think we all have a lot of trust in Kraken and Coinbase, but again, we can't just totally trust them because they're the comparison, right? We need to push for proof of reserves, and we got to, we have to until we get it.
Yeah. Switching gears, but staying on FTX, a lot of capital allocators had some exposure to it, either capital in FTX or portfolio projects that had Treasury and FTX. How are you guys looking at the situation of the OTCs? With Anthropic, now there's been like some excitement around recovery. If you look at the history of the space, recovery from bankruptcies is a very long, protracted process. The current OTC is about 38 to 40 cents. Do you take that and hope for 150% return profile in ETH over the next 2 to 3 years, expecting that the actual payout of FTX will be 2 to 3 years down the road, or do you stay patient and now you're an indirect owner of Anthropic, hoping for that to have $100 billion payout and then you get made whole?
It's kind of wild how Anthropic came out of left field to make FTX people whole, but outside the point, I'll take one side here. I would rather take the 40 or 50 cents, put it in liquid crypto and hopefully ride that up. And the reason is maybe a bit different than the money. I just wouldn't want to mentally have to wake up every day for the next 2 or 3 years wondering what my payout is going to be. It would just kill my energy and mental state, I think.
Santiago, what's your take on that?
Well, it depends on the kind of person and investor you are, right? Because, sometimes it's like if you have a locked position in a vacuum, you say, oh God, yeah, I would have just rode that until, ETH and sold at 3,800, like mark the top. Really? Like some people are just are not good at managing their portfolio. I go back to I think these claims traded at the lowest point at 8 cents on the dollar, right? Like a couple of weeks or a month into the collapse of FTX. A lot of people picked them up. You have to be wondering, I mean, I think there's a lot of interest from sophisticated players that are savvy in terms of litigation finance as a category. Or even distressed hedge funds out there that are saying, hey, 40 cents on the dollar. They're looking at the book. They're looking at the investments. They feel fairly comfortable. So it depends on the type of investor that you are. I would say I would side with Tommy here. I know we're supposed to disagree, but I would also take it because I have more confidence in my ability to outperform and manage kind of my own capital versus what worries me here the most is the people that always win in this process is the lawyers. I mean, they are charging an arm and a leg. It's just to your point, Ryan. I mean, if this process drags out years, there's going to be a material kind of net payout. I say net because gross would be net after expenses, which are really mounting. And I do worry about that. I do think that it's not as simple math as, oh, look, Anthropic's valued 100 billion. Oh, great, we're made whole. I think it's going to get more and more complicated. Although there's a fair amount of, depends on what you have too, right? I mean, I don't recall, but I mean, I think as people, as part of filing your claim, you obviously have to kind of agree with the amounts and stuff, but there's also, I guess there's just the hack that happened right as the collapse was unfolding. I'm not confident lawyers understand key management better than people that have been in the space for longer, right? I just don't. I think there's gaps there. I worry about that, of their ability to really custody these assets, put them in a safe spot. So for all of those kind of structural reasons, I'd rather take the money now.
Yeah, I think you guys hit the nail on the head in the two items that, if you're a capital allocator, you need to remember and prioritize your mind space and focusing on that. And B, as much as FTX was an all-time grift, the unwind is going to be just like an absolute fiesta of grift. And these lawyers are just skinning the thing. They have no incentive to push this forward. And if we look at,
we need to back a law firm.
Conferences and crypto lawyers have been the most profitable, highest ROI enterprises in the industry. Unless you're like a seed investor in Ethereum, you wouldn't have outperformed these folks.
Yeah. Good. So other things that you guys are seeing under the radar in this bear market, what are some things that you're excited about that people are not paying enough attention to?
I mean, one thing that I don't have fully fledged out thoughts on, but I'm struggling with is chains backing projects on chains outside of Ethereum and all the ZK EVMs, VMs built on top around it, Solana and Cosmos. Like, I'm really struggling to back projects outside of that world because, like, as you guys know, like, bear market sucks, excitement and capital isn't here, users aren't really here. Obviously, we're investing a ways out, but having to take like normal venture risk and then having to take like, TBD platform risk on top of that on a alt L1 or an L2 is just, sorry, an alt L1, it just gets really hard. And we are seeing a lot of deals on other ecosystems because they all have giant ecosystem funds. They're all backing these projects. So they come across as legit, and they have great founders and stuff, but I don't know, it just gets hard to get excited about it. Maybe it's a basic take, but yeah.
My former partners over at the Web3 Foundation, particularly Parity, just announced a major round of layoffs. And I think that is mostly in recognition of there's too much centralization in building out most of these chains. Like, if your team is the only one building out apps and infrastructure and wallets and integrations and things like that, you got to probably look yourself in the mirror and ask if you've got organic community. I think in the case of Polkadot, they do have organic community, but the question is, will these projects that have an order of magnitude less developer and like community interest have survivability, right? I think we all have confidence in ETH. It's hit escape velocity, it's hit network effects on developer mind share. Then from there, it kind of like falls off really, really quickly. I've mentioned to you guys before that we did a piece of analysis a few weeks ago that compared sort of the three generations that we've seen of blockchains or of smart contract scripting platforms. So Gen 1, Ethereum; Gen 2, the kind of like ETH killers, sort of Cardano, Solana, Polkadot, Dfinity, these guys of like the 2017, 2018 era. And then Gen 3, which is like Celestia, Fuel, Wormhole, and the ZK EVM layer 2s that are kind of like 2020 and beyond projects. And what we observed is that after a 180-day sort of like honeymoon period, the Gen 2 projects underperformed ETH over time to a man. Not a single one outperformed ETH beyond the 180-day mark. And then now we're seeing the Gen 3 pop up, and we're seeing continued erosion in those Gen 2 alternative layer 1s in favor of these things that integrate with Ethereum natively. So the layer 2s, and then these new layer 1s that come out of the box, like with apps, with privacy, with integration with Ethereum. And those are ultimately accruing value to Ethereum while extracting value from the generation 2. And we're seeing this kind of like slow drip and decline in value and community from Gen 2 blockchains. And that's not a judgment on quality of these Gen 2 blockchains, and many of them may come back like a Solana or a Polkadot. But at the same time, the vast majority are on a slow march to death. That's very clear.
Yeah. The other thing too is, like, I know it's early stages so like, you're an app developer, right? And you have to figure out where you want to launch a project, right? So obviously you want money, you want users, you want liquidity, yada, yada, yada. And there might be technical reasons why you want to launch your own chain, right? So you potentially launch on Cosmos, right? And people knock Cosmos, but it has it houses some of the largest names we know, right? Like Thorchain for cross-chain swaps, DYDX, Akash, I can go on and on, right? Like, these are projects that had real technical reasons to need customizations in their chain and their life. The issue, though, for the alt chains is the reason to launch there is starting to decrease, because now you can launch, or soon you can launch, a roll up and post data to Eigen or Celestia and have the customizability you want with the fast speeds and low fees. So the reasons to launch on Alt L1 are now going to go down. Now, let's fast forward a year or two. Instead of doing a roll up and rolling down to Eigen or Celestia, now you launch on a ZK EVM or a ZK VM, and you get the magic of, never having to do a fraud proof ever, and having the speed and low cost you need. So I don't know, the arc of technology for me is very much bearish that Alt L1 cycle, to your point, Ron.
I mean, I generally agree with you guys, and I made this mistake because I've invested in a lot of these, right? Over the like Filecoin. Brian, both you and I were early investors there. Looked at Definity, have invested in a number of others. Why? Because as one, a hedge to Ethereum. I generally think we're still very, very early. Two, I also believe that it will be a multi-chain world. And one of the things that probably doesn't get talked about enough is the connectivity between chains. And one of the more probably underrated things, Tommy had a great thread about this, Cosmos, which is one of the more underrated ecosystems. I think it has great, fantastic tech. Like IBC took a while to launch. It was hugely delayed. But in spite of all the clusterfuck that happened within Tendermint as an organization, they eventually shipped it. And I remember talking to Zaki and Jack, because they're continue to develop. And my question then was, hey, could IBC at some point like connect to Ethereum in the same way that it connects like different parachains, or not parachains, but different like Cosmos chains? He's like, absolutely. Like we're working on that, and it could be. And so my view here is, at the end of the day, I think we're incredibly early still. Now, if you ask me what I've done, yeah, most of my investments are in Ethereum, because that's today the mind share that both developer and the attention from the retail, if you want to call it that, or institutional, is on Ethereum and Solana on the margin. And everything else from that is just drops off dramatically. But I think in a fast forward to 5 years from now, people will not care where these things settle. Ultimately, they will care about the result. And I do think, I think it's too early for me to have like absolute certainty, which I never have on anything. But I do think it's still worthwhile to pay attention to things that are happening, particularly in Cosmos, particularly also in L2s. But one of the other things that was brought to my attention during the Blockworks conference, permissionless, was Filecoin. As a chain that has probably most people are not paying attention to, but they're building they have some fascinating like proof of replicability, proof of retrievability. They pioneer some really interesting stuff. And so I do wonder, a lot of these, call it left for dead chains, have continued to develop, have continued to make progress, and are not in the limelight, but they're very well capitalized, and they have some really smart people working there. So in a world of open source, the question to you both is, should we be paying more attention to stuff like Filecoin or, Cosmos? I'm just kind of curious how you think about that.
Yeah, I mean, definitely interested. The Filecoin side did come up a lot at that conference. I wish there was like a track or a panel to figure out who was building on that. But Ryan, I know you probably have better thoughts here.
Yeah, I mean, the first thing that I observe about Filecoin is that the Protocol Labs team is the most talent dense team in the entire space. It is extraordinary. It is just like such high intellectual horsepower, top to bottom, in that group. And just, remembering that they've built a number of protocols that are all very useful in the space, libp2p and IPFS, which stores most of the decentralized NFTs in the space. Filecoin is an incentivization layer on that. I think you'll see more interesting protocols come out of Protocol Labs that share resources over time in really compelling ways, whether that be like internet service or electricity or who knows what else. So I personally would never bet against that team, because it's just an extraordinary group. With respect to to Filecoin in particular. I've been writing checks in the Filecoin ecosystem, obviously since day one. Just wrote another one to Glyph a few weeks ago, which offers a yielding on your Filecoin, which is particularly useful for me. And that's what I like to invest in when I'm using something. And as a user, I find it useful. And then I write a check. There seems to be this uptick that's happened in the last, not even 6 months, but kind of 4 months of people coming back to Filecoin. There was some hype around other storage layers in the space. And I think that has mostly proven to be, not real. And people are waking up to the fact that most of the ecosystem uses some form of Protocol Labs protocol, and thusly there will be value that will accrue in the Protocol Labs broad ecosystem, whether that be specifically Filecoin or a range of different things. Who knows? I just think it's smart for capital allocators to have some exposure there, and the only way they can get exposure is Filecoin at this point. And so you should have some exposure to that, because never bet against Juan Benet. Juan Benet has the technical talent of Vitalik, but is also like a rock star, full toolbox CEO. He is a unique talent, and that permeates into his entire organization. And I'm, again, I would never bet against him.
This episode is brought to you by Toku. Toku makes implementing global token compensation and incentive awards simple. With Toku, you get unmatched tax and legal support to grant and administer your global team's tokens. From easy-to-use token grant award templates through token vesting to managing tax withholdings, Toku understands every grant structure: token purchase agreements, restricted token awards, restricted token units, token options, token appreciation rights, and even phantom tokens. For legal, finance, and HR teams, it is a huge, complex task to have to comply with global regulations around compensating people with tokens, not to mention the payroll, tax obligations, tax reporting in every country that you employ someone. It is difficult, time-consuming, manual, and costly, and it is drawing more and more attention from regulators and governments. Toku makes this simple for leading teams across the space: Protocol Labs, DYDX Foundation, Mina Foundation, Hedera, Gnosis, Safe, Gitcoin, and a lot more. Reach out to Toku at toku.com/empire or click the link in the description.
Yeah. Actually, Tommy, I want to ask you this question, because this is perhaps one thing that gets overlooked, which is what part of the stack is not decentralized? And storage, of course, is hugely important, overlooked, I think. NFT collectors probably don't even care to think about where the storage itself of the file of said JPEG resides. And a lot of it is in a centralized party, AWS server. And is that truly decentralized? There are multiple parts of the stack that when people talk about decentralization, they just think of it as one thing. But as we know, there are different pieces of the stack, whether it's your stablecoin of flavor. Well, that's not very decentralized, but hey, are you willing to accept that as long as you know the risks? And that's okay. But there are, to me, the thesis back then when I wrote the check to Protocol Labs, and today still is, well, yeah, storage is a critical infrastructure layer in the Web3 stack that needs to be decentralized. You need to keep this storage, or have the ability to keep it, provably safe, decentralized, distributed and decentralized, two different concepts, but you need to have both, I think. I'm curious, if you think there are certain parts of the stack that are overlooked when you think about, hey, we're not really paying much attention here, but we probably should. We should spend more time. I know there's this broad kind of outcry in the industry that we've spent far too many dollars on infrastructure and not enough on consumer applications. Mm-hmm. I generally think that's true, but again, the key word of the episode is nuance. There are parts of infrastructure layers that have been neglected, maybe because they're really tough, they will take longer. I'm curious if you agree, disagree with that, and if you guys have invested in particular parts of the stack.
Yeah, I think it's a good question. I mean, not to take your question a different way, but I think the thing that I would love to see in crypto is a website where you input your end product, an NFT or brand, BlockFi, or whatever you want, and it shows you where you can get rugged, right? Like just front and center, this is where I can get rugged. Like it's an NFT creator updating the metadata and linking somewhere else. It's BlockFi sending all of my assets to FTX. Um, you know, somewhere where I can figure out, you know, this is the risk I'm taking by using this L2 is that there's a centralized sequencer run by a team that's nobody really met them or knows who they are, and they're not going to include your transaction and you're screwed. Like something like that that you can visualize and feel, I think would be really helpful next bull run when people are just kind of aping into flashing lights in unaudited contracts. Yeah, I'm not sure if that answers your question, but yeah.
Yeah, I think that would be hugely valuable. Go ahead, Ryan.
Yeah, I think we could have more decentralized networks for sharing different types of resources. So like, you know, Helium took a swing at internet service provision, and that was an early experiment. And I think, you know, we could have more of those. I think we could have some experiments around electricity, around driving networks, like a decentralized Uber. Like there are other resources beyond financial transactions and smart contract execution steps that could occupy block space. And that would be A, intellectually compelling to test, and B, probably valuable over time. Like one of those resource categories probably gets traction and probably disrupts the traditional business model of that industry. You know, we need more things like Filecoin that are using decentralized networks to share an important resource.
Ryan, so that brings up like a curious point, right? Like the idea with Helium, the idea with Filecoin, the idea with like the DPIN networks and all this stuff is to move from centralized providers to decentralized providers, right? And generally that means going from like these large data centers that are built ridiculously with retractable roofs and redundant power and backup generators and all this crazy tech to, you know, running your latent hardware on your Mac or your phone or stuff like that. Is that your thesis? Is that like that transition will happen because it's cheaper or more scalable or more secure, or like, do you view a hybrid model, or how do you think about like that shift?
If we go back to like what our original thesis was around Filecoin, and Santiago, I imagine you shared this at that time, is that like, what is the marginal cost of the unused file storage space on your server or your desktop or your laptop? It's zero. So if I get anything for that, it's like actually more efficient use of my capital. And I used to use this example of, well, you know, you may make like kind of tens of dollars per month or per quarter for renting out your storage space on your computer. And that doesn't move the needle for you and I, but that may enable a kid in India to buy a computer and finance it by renting out the storage space over time. And so like for that person, it's an incredible enabler. And that's why this idea that the crowd could outperform data centers over time, it made sense. And, you know, very frankly, today we observe that the cost of storing on Filecoin or on IPFS is cheaper than AWS. So like the supply side has worked out. Unfortunately, the demand side has not worked out. And, you know, you can make the easy out of like, well, the UI isn't there, and well, the awareness isn't there, and well, you know, this and that, and the other thing, people don't want to buy a crypto token to pay for this, and that doesn't make sense. But I don't think those are actually the reason. I don't have a silver bullet answer of why we haven't solved the demand side. But I do have faith that the demand side will come because the supply side is cheaper. It's cheaper to store on IPFS with Filecoin than it is in AWS. And that will one day find product market fit.
I think it would be, I 100% agree with what you just said, Ryan. I think it would be a much more difficult situation if the demand side was not, if the supply side was not there. And my thinking going in, and I think one of the mistakes a lot of people have done on these decentralized file storage systems, call it Filecoin, IPFS or Arweave, is assuming that all storage is going to go on a decentralized fashion. And that's just not correct. I think it is a matter of how much do you value redundancy in your storage layer, meaning it is complementary to your storage. Certain critical, mission critical pieces of data, parts of the web, archiving the web, are merit having this added layer of decentralized storage purely for retrievability purposes. Not everything, right? But if you have a very secure thing, well, yeah, you would want to, and not only just use Filecoin IPFS, but also pay, because there's different tiers of storage that you can have in the system. You could pay more to have it sharded and, across different nodes, and have a higher degree of confidence in the retrievability of said files. And so I think that flexibility is really, is going to over time be highly valuable to some players, right?
Yeah.
And I think that's overlooked. I think the complexity and the tech behind like the proof of retrievability is I think this retrievability, and there's another proof here of I said it earlier, but anyways,
proof of replication.
Proof of replication and retrievability are two different,
and
but
proof
also,
of retrieval.
Yeah.
So one is like you can produce this, and then the other one is like the speed and latency at which you do so. Yeah.
Which those two things are really novel and I think not fully appreciated, and will end up being useful, as you said, to other different protocols and use cases. So I think it's mission critical. The challenge always is the price fair, and how do you value something like Filecoin? One of the interesting projects is sort of like the mining of Filecoin, which is a huge thing, and like being able to like sell the future mining rewards and whatnot. So anyways, there's a lot of interesting things happening in that ecosystem. I don't follow it enough.
Ryan brought up Helium before, and that was the project that I first started mining like early on in crypto, right? And the interesting thing is we're talking about how we have supply and we don't have demand, but the crazy part is like historically the wireless companies like Verizon, T-Mobile, AT&T, whatever, Sprint, like they always had this really long battle with the cable companies because the cable companies provided internet to your house and they were never able to break into wireless, and the wireless guys provided wireless and were never able to break into wireline. So the whole idea that Helium comes along and basically they say, hey, look, you're going to resell your cable, your wireline connection to your house and compete with the wireless companies is an idea that's like breaking decades of industry lock-in for like $100 billion companies, right? Like it's a really interesting point, but I mean, obviously eventually these wireline companies are going to wake up and be like, look, you're reselling your internet, pay us. And I think they'll work something out, but it's just an interesting point on demand. And that's $5 a month to join that wireless. It's definitely cheaper.
What is your take on where Helium is?
I haven't been tracking it as closely as I used to, but the things that irked me were the token econ side, like never made sense to me. Like the idea of multiple tokens that wrap up to the main Helium token, like the econ flows just didn't make sense to me. And if you run the math, it gets difficult. But that being said, like on the flip side, they are one of the most successful projects to ever touch the user, right? Like they've put 1 million IoT nodes in homes. Like now they're doing 5G and they're disrupting the entire telco wireline competition segment, right? The biggest risk, in my opinion, is that the wireline companies, the guys that you pay for your internet service to your house come along and they say, look, you're breaking your contract by reselling your internet. We're not okay with it. Or they can say, look, this is finally a way we compete with the wireless companies. Give us half your earnings and we're okay with it, right? Something like that. I don't know how it's going to play out, but
do you think a Starlink just completely disrupts them together with the wireless companies? And it's just like,
yeah, that is a big concern.
Moot point because they just
no, not at all. That's a real risk. Yeah, for sure.
Yeah. The other question that I have there is, can any project have traction after going 98% peak to trough? Right. Like when you write down 98% or more of community capital, like how do you recover that community?
You just said Filecoin, sir. Filecoin did that. And here we are. Filecoin at one point was like 1%. Filecoin at one point was like, I keep saying this, like up to like 0.75% of the world's GDP when it like launched. There's still interest. There's still interest. And you just said something interesting on the supply side. If you have something that wasn't like, if you're not making anything on that excess storage, you want to take like rationally game theory would say you're willing to take up to 1 cent or whatever, right? Because it's better than getting nothing. I think it's the same true, not for all ecosystems. Like if you're a JPEG collection and your price just collapsed 99%, buy con Dios, amigo, good luck. This is why I think, again, nuance. I am highly skeptical of artists moving into this direction without being very thoughtful. And music royalties on chain, like all of that, I want to believe it. I just think it's challenging. Because like even friend tech, like the minute you introduce a financial incentive to something that people aren't used to or weren't expecting or would do it purely because of goodwill, I think it really psychologically tampers with that. And studies have shown time and time again, like there's times that people do things out of the good naturedness of their heart, like charity. The minute you start compensating people for charity, it's like, wait a minute. Like, no, like you shouldn't touch certain things. But if you have excess storage, yeah, sure, I'll take a cent. Excess broadband, sure, as long as AT&T doesn't come knocking on my door. And if they do, well, okay, slap me on the wrist. The same with that. Airbnb is kind of like treaded this kind of fine line with regulators and condo boards and all this stuff. So I think it depends. I think it really depends on the type of project that you are.
One example here you guys might remember, probably more than I do, but like Jensen, Akash, a bunch of players are doing, use your compute, your GPUs to train these models, or for model inference, which is different from training, right? It's like calling the models. Why did Golem never take off? Do you guys remember that one?
Oh, yeah.
Yeah.
There's some wallets that I have all these like MadeSafe and Golem and Ryan. We can go down this list.
But it's curious though, because it's like a decade before it was useful, right? Like,
yeah, I mean, I think in the case of Golem, my understanding is that like the actual tool was just not useful, right? Like to do the rendering on Golem was sort of decoupled from the token, and then again, there's an example where enough people got burned that a community like exited, left, and also the team migrated on to do WorldCoin, right? Like a lot of the Golem team is now the leadership team at WorldCoin. And this sort of cuts to how much a founder group defines the success of a project over time. Tommy, you and I have talked about founder likability on your pod before, and how that can affect project, but also like founder ambivalence, right? When you get a founder who starts doing venture allocations and running a fund and doing other projects and things like that, like it's going to have an effect on project. And I think Golem was one of those things where they needed the technology to evolve a little bit. They could probably execute it better today than they did at that time. And And then it just lost momentum because the community lost interest. However, that's one of those interesting things that we should maybe double click on, which is massive treasury still sitting around. People have these tokens. The treasury is worth more than the fully diluted market cap of the tokens. Why isn't there an activist investor trying to hold people feet to the fire and get them to unwind these enormous treasuries? You get the same thing with Tezos's, I think, like 10 cents off its crowdfund price. And like, when is there a point where you're like, hey guys, that $600 million that you got sitting in Switzerland, maybe just redistribute that to
diversified their treasury fairly well before the crash, I think.
For sure.
They raised.
Yeah. But like today, there's all that money, is there an argument to unwind it and redistribute the way that DigixDAO did back in the day? Or is that just like locked up capital and that's, a trust fund for these founders forever?
I think on that point of self-policing, like there's two things that come to mind. One, I think there ought to be a role for more activism in the space. I think done in a good way. I think there's been attempts of doing this that have backfired. I think also the industry sometimes is really soft when it comes to really portraying VCs, and anyone that tries to challenge a team, a founder, of saying, oh, you guys are VCs, vilifying the VC community, which I think is widely overblown. And I think the VC community time and time again really steps in in moments during bear markets of critical funding needs. Like there's a time and a place, and not all VCs are created equal. I agree with that. But I think there is a lot of value in having a VC involved. And I think there ought to be more activism. The other one, quite frankly, Ryan, structurally, you talk about Tezos, a lot of these are receipts. When you invested in this crowd sale, all you got was a thank you card saying, hey, thank you for sending us, $1. That's it. So from a legal recourse perspective, there isn't much. And again, this goes back to, imagine a world where all these ICOs happened, where you had regulatory clarity, where there was a proper guideline, maybe crowdfunding mechanism, rules, guidelines, where there could be an unwind mechanism, maybe triggered by a smart contract, executed by certain parameters. Vitalik has introduced certain blog posts and ideas around, even the DAO, right? It was sort of like the way you go about funding. In an ideal world, if you could wave a wand, you could say, like the same way that biotech goes through these kind of milestone driven funding. And if you don't deliver anything, you kind of you return capital. Like that could be semi-automated. You could have a council that is overseen by community members and there could be much more structure. But because we've had to kind of operate and tread the needle with whatever your top law firm of choice is telling you to do and the way to structure these things, unfortunately, it opens a vector for the bad actors to exploit that uncertainty. And that is, I think, the point that regulators need to understand. If you don't have clarity, there's going to be someone that's going to exploit that. And and that's the problem. FTX, they exploited this regulatory jurisdictional thing where they said, okay, we're just going to skirt and circumvent the US and we're going to go through these kind of different jurisdictions. And lo and behold, this is what happens. Whereas the US-based exchanges haven't, right? Kraken and Coinbase.
The other thing too, though, is it's just the worst and most perverse incentives. Like if you're a founder and you really don't want to work, go to a Tezos, raise a bunch of money from their ecosystem fund and coast. Why not, right? The sell to them is they need developers and projects you're going to actually deliver, maybe not. I'm calling out Tezos, but you could extend this to a lot of other ecosystems. And you get a paycheck.
I guess we could all feel good that they sponsor Manchester United, and if we could all get Manchester United shirts, that'd be nice. Yeah. But not even that.
I was a Tezos bull in the past, so I get it.
So was I. And although Sanji, you kind of hit the nail on the head with respect to jurisdictions, and I know that the three of us sit in different jurisdictions for different reasons, whether US, Europe, Switzerland, which I don't consider to be Europe, or, I'm here in Cayman today. And it's interesting that different projects and different funds come to this realization. Like we've been in Cayman for a long time now, and we feel like we're entrenching here. And I also feel that like the act of coming here, which is the exception rather than the rule, our business partners always tell us that we're one of the only groups that like comes down and does board and does strategic stuff and like, tries to have presence really here is actually a really healthy process that allows our partners to understand us better and understand our business better. And also the like ceremonial act of like going through it is really healthy for decision making and just for focus in the organization. But we do have this concept in crypto that I think will broaden to the world over time of jurisdictional competition, where you can very quickly go to the jurisdiction that you find most attractive. And it's never a one size fits all. Although I do note that in today's environment, correct me if I'm wrong, but I would guess that like somewhere in the range of 75 to 80% of projects are finding their way here to Cayman or BVI these days. Would you guys agree with that?
Can you like fast forward that for us? Like, what does that look like 10, 20 years out? Like everyone's a nomad, going to the jurisdiction you want. Like
countries don't exist.
Yeah.
Yeah. Well, the way that we look at it, we get a lot of people like crypto natives reach out to me because of our setup and ask like, hey, I want to go through this like tax optimization project and jurisdictional competition and moving into the ideal location. I'm thinking about Portugal. I'm thinking about Switzerland. I'm thinking about where should I go? And the decision tree on it kind of starts out as like, are you American or not? And then if you're not, it's like, okay, do you want to live in the place and do you want to have presence? Like, do you want to be a digital nomad? Do you accept some taxes or does it have to be zero? And like the decision tree kind of goes on from there. And then if it's American, it's mostly like, well, you're fucked. And the most you can really do is kind of do the Puerto Rico thing. But by the way, Puerto Rico requires 183 days. You better like surfing. You better like that lifestyle, or you can limit state tax, by going to Texas or to Florida or some other places. And, and then you get a lot of Americans saying like, okay, I want to renounce and I want to move on. And I'm going to completely optimize. So like, does Portugal make sense for me? I often say no, because you should look for a jurisdiction where the tax, the tax benefits or tax zero is culturally ingrained into the fabric of the society. So like Cayman is politically impossible for Cayman to ever impose taxes. It is totally unacceptable among Swiss society to impose cap gains taxes or change the tax code. Portugal is a socialist country that made an experiment on a golden visa, and like one change in the government could completely upend that.
No, it already did. It already did. They peeled it back. They started to peel it back 2 years ago, and I said this is the time to short real estate prices in Lisbon. And there was, to your point, Ryan, it just felt like they were going to rug you at some point. Spain has these 2-year, 3-year, 4-year, but it's a novelty. It's not, as you say, the reason of existence for some of these jurisdictions.
Yeah, for sure. Yeah. Whereas others, like, they have benefited through so many generations and seen the benefits of tax optimization, almost like meditation, where like it takes you a while to realize the benefits and then you're bought in. It takes a country a couple of successive generations to realize that, oh, actually, like giving on the tax, on like cap gains tax especially, means that you get more high net worth individuals in the door, means that you get a lot more other benefits. And because of that, we're bought in and we'll never change it. And there's only a few places around the world where that's really culturally ingrained, and then the place operates reasonably well. So like, sure, you can get zero taxes in Panama, but like to do banking, you're going to be put in a red channel in banking because of the whole Panama Papers thing. And to do business is difficult. So it's like, you're just doing a different tax. Or like you could go to Luxembourg or Liechtenstein, fine, you have no taxes, but you get death by 1,000 paper cuts on administrative fees and banking fees because the royal families own the banks and they charge you bips in and out for banking transactions. And like, wow, that's just a tax dressed up in different clothing, right?
Yeah.
So
there's never,
it's interesting.
as in economics, there's no such thing as a free lunch. There is always a trade-off. Now, I do think that like it depends. There's two things here that maybe we can double click on. Is one is if you're in crypto, the regulatory environment is probably paramount. Secondary is the tax component. As a project, as a foundation, there is a very clear divide and sort of bipolarity in the world that is increasingly kind of becoming more and more like that divide is growing. It may compress and revert, but generally speaking, like you are seeing places and jurisdictions like United Arab Emirates, i.e. Dubai, Singapore, Hong Kong, the UK, the European Union as a whole just being more pro innovation, pro crypto, more welcoming of the industry, and other jurisdictions, particularly in the US, is just hostile. And maybe uncertain. Like I think the courts have given us a glimpse of hope in what could be a path forward where the rule of law and like the intent and a path forward. I think increasing the regulators understand that. But right now, like most of the projects that you're funding, they're not in the US.
Yeah,
they're just not.
A couple points there that also just to add on, like recent events, like Celestia aggressively excluded the US. Like you can't access that airdrop if you're in the US, right? They did a really good job. That means that builders outside of the US are going to have capital to build, and the best projects built on Celestia will probably not be in the US, right? DYDX aggressively blocking the US, right? Eigenlayer allowing middleware to access nodes, and the nodes can choose and market themselves as geographically not in the US, right? So they'll start to earn a premium because they're not worried about being in the US and their projects getting shut down by the government, right? I spoke to one of the largest market makers this week too. Not a single node co-located in the US, right? Like, so I agree. Like, I agree with you guys. Like, Ryan, you're right. Like, it has to be like jurisdictionally built into their culture. And Santiago, you're right too. Like, it just makes sense that it's hard to build here.
I mean, I think over time, like your point, Ryan, around capital formation will, I think, look vastly different in a world where in a world of internet money. And I think we've increasingly gone in that direction. Like, I just think, like my vision, like when you first discovered Bitcoin, it was like, this, extreme scenario, this separates money and state. That probably faces a big resistance. In a better version, it just keeps governments in check because there is a neutral layer money that exists. And so you can't all of a sudden print without serious repercussions, even though you are the top 3 kind of reserve assets in the world, because now there is an alternative. And that alone brings more responsibility to a system that has gone far irresponsible for too long unchecked.
Yeah, for me, the draw originally of Bitcoin is my frustration today, which is also, I think, going to be the solution in the long term, which was I got attracted to Bitcoin because of its potentiality for crowdfunding. I was a venture capitalist specifically in crowdfunding, and I thought that crowdfunding was one of the most interesting things that we've ever seen. And obviously, Polychain dominate the sort of the ICO era and crypto. And we were really excited about this idea of crowdfunding. And I think that there will be a new like crowdfunding or new ICO era once we get like the regulatory clarity in the US that will dwarf the previous ICO era. And like maybe if the only use case of crypto is crowdfunding, I don't care. Like, that's already worth trillions of dollars. That's a great use case. And we don't need to do anything else. We don't need to like have storage or ISPs or energy or anything like that. If we can just do rapid capital formation among people who want to try and experiment together, and that should be allowed. And so I find that to be the greatest point of frustration for me in the space today. Like, everyone's like, oh, there's no use case of crypto. And I'm like, no, there actually was a really cool use case. It's just kind of not allowed temporarily, but truth will prevail. And I think that will be, I think we'll get to a point where we can do this rapid capital formation freely among people who want to try these experiments among each other.
What do you say to people that say, wait a minute, a lot of people got burned. A lot of people didn't know what they were investing in. Like, would you say on one side, total libertarian, hey, it's their money, they already pay taxes on it, let them do whatever the hell they want to. On another side, it's like, no, wait, let's allow that, but with the right disclosures, information, registration, if you will, but that costs, that's administration, that's, whatever.
Yeah, I think like the coherent regulation will be one that is not patronizing. So it's not like, we're trying to protect you from this free internet money that could be worth 1 cent or 10 cents, but it's free anyway. But at the same time, like, reasonable. So for example, like, disclosures should be necessary. What we just talked about before, that if a project doesn't hit milestones, they redistribute the capital rather than just keep it as a trust fund for the founders. Those things should be implemented. Like, there's a really simple, straightforward path towards a mature regulation that treats people like adults. Because guess what? If you're going to put your money into highly risky things, like, you're an adult, that's fine. You should do that. The same way that, like, if you're an adult, you can skydive, and that has risk. And I feel like it's not that difficult. It has been made difficult because of the, like, political process and the, kind of alternative or ulterior motives that are at play especially in the U.S. political process. But what are your thoughts? How do we come out with the solution here?
I think we push our solutions for next episode, but I think that there's a lot to talk about on the capital formation side, and also, not to cherry pick Eigenlayer, Ryan, but the idea that any middleware provider can now access the capital, aka security, through validators by marketing to them, is a form of potentially indirect crowdfunding, right? They get the security they need without having to, go out to talk to investors. But a rapid fire question in closing, guys. Our crypto Twitter timeline is probably the most bearish as I've ever seen it. Is that a counter indicator for you or not? Santiago?
Are you on the For You tab or following? Again, nuance. Nuance, gentlemen.
Yeah. Nuance prevails.
Ryan, I will give you credit here. I really like this word, nuance. I will stop saying it because people are going to kill me in the comments.
Should we call the pod that?
It's nuanced.
Potentially.
I think I've done a really good job of curating and unfollowing and following the right people. I do agree with you. It does feel like, look, there's a lot of stuff happening in the world. I think emotions are high. It gets conflated. Crypto Twitter is this really vocal, like, the people that are in crypto Twitter, I think, tend to be curious and want to vocalize and talk about a lot of things. There's like the trial going on. There's the whole Israel war going on. Like, there's always the macro commentary. There's the hacks that are going on. So I think a lot of it is, look, social media platforms tend to skew negative. It's people that, there's this idea of a vocal minority that I'm highly cognizant of. Whatever you see in DAO forums, and especially in Twitter comments, like, if people take the time to do this, like, they want to vent. I think as a world, as a society, it's very woke. And so that's why you have the anon culture, because people at the end of the day want to vocalize, they want to vent, and they want to do that in maybe a pseudo-anonymous or a pseudonymous
Santiago,
like,
it's a good answer, but you're giving me the lawyer's
it's a rapid fire. Look, I am allocating.
Bearish?
I am bullish. It doesn't compute in my thinking. It just doesn't. Like, I think it's a counter indicator. I think it's a good time to allocate, purely because the number. It's a matter of price. Things have been left for dead.
Ryan, you're up. Santiago, I'm with you. I'm a buyer here, but Ryan?
So very quickly, rapid fire, because we've got to wrap it up, and clearly there's construction in our office is wrapping us up. Yeah, I mean, I do think that we're going to look back on this as the bottom of the trough, whether it's now plus 6 months or whether whether this is like, the absolute trough. This is a great time to be accumulating high quality assets because this space matters and there are use cases that matter in this space, and that in the end will prevail. So,
Ryan, you got
thanks, guys.
a picture of this
Tommy, I'm going to ask you. No, I'm going to ask you a fire question here around allocating, as famously was said by one of the witnesses in the FTX case. Do you know the distinction between solvency and liquidity? And are you allocating?
That's a good one. We'll cover it next episode.
All right, gents.